It looks as though driver capacity may finally be coming down, which would allow for trucking rates to increase without an influx of freight volume, as owner-operators begin to exit the market. It seems that a large number of drivers who became owner-ops during that last freight boom, well, now they're starting to shift back into either company driver roles or just parking their trucks and walking away from the industry altogether. The final numbers from a study focused on 2023 trucking detention hours and the amount of time drivers were held off the road and stuck at customers' facilities are eye-popping. We'll also check in with Jason Miller for his latest take on the economy and take a deep dive into all the recruiting and freight data you can handle. For Randall Reilly, I'm Joshua Miller, and this is the 30-Day Reset. Hello everyone, the spooky season is upon us as we roll into October. Welcome back to another edition of the 30-Day Reset. We're back each and every month to take a look back at all the data to give you a better understanding of what lies ahead and help you figure out how to move forward. If you like our show, don't forget to like, share, and subscribe if you're over on our YouTube channel. If you're over on the Randall Reilly site, you can sign up for our monthly newsletter to be sent a sampling of some of our latest video and written content from each month. In either case, you can download your very own copy of all the data we cover today and a little bit more just by clicking that link down in the description over on YouTube or filling out the form that is down below the player on our Randall Reilly site for this month's edition of the 30-Day Reset download. Now that we got that all out of the way, let's go ahead and dive right into it, shall we? First up, it's Trucking by the Numbers, brought to you by Stratus Strategize. As I mentioned in the open, the number of owner-ops in the market is decreasing, as a significant number of them are either leaving the industry or choosing to return to fleets as company drivers. While this decrease in capacity may indeed end up leading to some rate increases, it also resulted in owner-op lead costs rising. August's average CPL went up 5% and looks on pace to increase another 7% when the September numbers are all totaled and finalized. So far, however, the lead cost increases have not led to too big of a spike on the higher end. Average owner-op CPH did go up 3% in August, but so far, not too much of a hike. Conversely, the average lead and higher cost for company drivers has dropped quite a bit. CPL was down 8% month over month, and the CPH for company driver campaigns fell by a full 17% in August, which happens to be the most attractive level in 4 years. Through the first half of September, the search volume for driving jobs was down 9% month over month, while the cost per click averages for search and social placements were virtually unchanged. Over on the freight side of things, according to FTR data, there wasn't a clear-cut impact from Hurricane Helene in the data just yet, but the Southeast did see a bigger increase in dry van and refrigerated volumes compared to the other regions. Next month, we may be able to see a little bit more of just how big of an impact the storm actually has had on activity. Overall, load volume was down 6% year over year and 33% when you compare it to the 5-year average, while overall spot rates came in 5% below last year's tally for the same week and 10% below that 5-year average. Now, when it comes to the different segments, dry van loads were down 27%, with rates dipping by 7% year over year. Refrigerated loads were down 7% and rates down 4% year over year, and flatbed came in with an 11% increase year over year for load volume, while the spot rates dropped by 5% compared to last year. If you'd like to dig through the entirety of the data, including CPL and CPH averages for all the different driver segments, Google Trend scores, and more, including all the 5-year average comparisons for load and spot data, don't forget to get your copy of this month's download, available below. Now, let's talk about just how much detention hours are costing trucking with this month's news story. The American Transportation Research Institute has released its findings from a study conducted in 2023 into the negative effects of driver detention at customers' facilities. And while driver detention has actually decreased in the last few years, the findings are pretty staggering. The ATRI reported that drivers were detained between 117 and 209 total hours per year, bringing the total lost time attributed to driver detention to 135 million hours in 2023 alone. Data indicates that drivers were detained in 39.3% of all stops, with the frequency increasing to 49.1% for women drivers. The overwhelming majority of fleets do charge detention fees. However, less than 50% of those detention invoices are actually collected on. In total, the trucking industry lost $3.6 billion in direct expenses and another $11.5 billion in lost productivity due to driver detention in 2023. On top of the lost revenue, those detentions could be contributing to some unsafe driving habits too. The study found that trucks that were detained then went on to drive an average of 14.6% faster than trucks that were not detained. Data also showed that trucks that were detained actually drove faster than average on trips to the facilities where they were detained, seeming to indicate that the drivers know exactly where they're most likely to be held up and lose some time. CR England CEO Chad England had this to say about the results. Detention is so common that many industry professionals have accepted it as inevitable without realizing the true extent of its costs. He went on, ATRI's report puts real-world numbers to the true impact the truck driver detention has on the trucking and the broader economy. The link to the full story over on Truckers News is included down below and is in this month's download. You can also find all kinds of other great stuff on the site like driver polls, industry news, and even more videos. Now let's check in with Jason Miller for his take on the economy.
Everyone to another freight market update. As we look at the end of September, start of October, starting out with where dry van spot rates are, again, our canary in the coal mine. Unfortunately, September has not been nice. We have seen, per DAT, dry van spot rates have given up all of the seasonal gains that they experienced in June. And so we're basically back to kind of where we were before, before the summer bump. So we're pretty much back to May levels right now. Broker buy contract rates have come down a little, but it's been very proportional. And when we look at the spot market cycle indicator, that is broker buy contract minus spot divided by the average of the two, we're right now hovering around 17% or so. For September, that is well above the sort of magical 10% threshold that's always indicated whether we're shifting into a bull market or, if we're rising above that, shifting into a bear market. So I just don't see any signs yet of things changing. Even if we have a port strike, any type of disruption is still going to be temporally limited. It's not a sustained increase in demand. And so at this point, I'd say it's time to write off 2024. We are not going to see the dry van truckload market turn the rest of this year. We're going to have to wait till 25. Now, off of that piece of depressing news, there is a little bit of, some things to be optimistic about. So first, when we look at seasonally adjusted trucking demand, July was actually a pretty good month. It was very strong. It was about a 0.7% increase from where we were in June on a seasonally adjusted basis. And this really is indicating that not only are we certainly at the bottom of the trough, but we may be getting set over, I'd say, the coming 6 to 9 months to start getting ourselves off of that trough and seeing a fundamental increase in freight demand as we start to see interest rate decreases start to have a positive effect on the freight environment. Now, that doesn't mean, though, that all sectors are doing poorly or need to wait. Right now, if you had to pick one freight generating industry to target, anything that is touching on electrification. So, for example, electrical equipment manufacturers, so this is your companies making transformers and dynamos and switchgear and things of that sort. Production in the United States has been, no pun intended, surging upward over the past several months. And that is being supported really by data center demand, just the incredible computing power needs of artificial intelligence generate a tremendous amount of electricity demand. And as perspective of this, Microsoft even recently agreed to buy all of the power for one of the units from the 3 Mile Island nuclear reactor that is being specifically restarted here in a few years. Microsoft is buying all of the power from a nuclear reactor to help power AI computing. So right now in that sector, production is 25% above where it was before COVID and 25% before 2017 in terms of making power generation equipment. So very strong demand right there. Equally on the, wholesale side of kind of the sector that touches on this, electrical, electronic goods, household appliances. This is the sector that sells solar cells. And right now, solar cell imports are incredibly high in the United States, about 350,000 metric tons a month. So when you think about that number, that is an incredibly large number of containers coming in each month that is just solar cells. Right now, we're seeing wholesalers in that general sector. Their sales are 30% above where they were before the pandemic, and they're even above where they were in the prior peak of 2021. So we're seeing very strong demand for any of the industry sectors that support electrification efforts. So if you're thinking, where is there demand growth right now? That's where I would be looking. So that does everything for this month. Hopefully next month we'll have some good news on a port strike situation getting itself, hopefully by that time, worked out, and also getting around for the gear up for the holiday shipping season. So with that, everybody take care and be safe.
Thank you so much, Jason. As always, we appreciate your time and expertise. Sooner or later, we'll have to climb out of this trough, right? Don't forget your copy of this month's 30-day reset download containing all the data covered today and even more. There's also links to a consultation if you'd like to see how we can work with you to meet your goals and for Stratus Strategize. It's a great tool with tons and tons of data for you to really drill down into. Both of those are available down below. Hope you all have a great October and a happy Halloween. And until next time, thanks for watching.